In this video, we're going to be performing a deep dive on Broadcom's dividend safety. To begin, let's talk about Broadcom's business model. Broadcom designs, develops, and sells semiconductors under the following business units: wired infrastructure, wireless communication, enterprise storage, and industrial. Its offerings include data center chips, factory automation, energy system and power generation, Broadcom access, and home connectivity. It's a fabless semiconductor company, which means that the products it designs are manufactured by other companies, so-called foundries. Broadcom has recently re-domiciled to the U.S. and is now headquartered in San Jose, California. The company was founded in 1961 and currently trades with a market capitalization of $106 billion. Broadcom's 8-year track record of rapidly rising dividend payouts has given it a reputation as a reliable dividend grower. With 2 more years of consecutive dividend increases, the company will become a dividend achiever, an exclusive group of dividend stocks with 10-plus years of consecutive dividend increases. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Broadcom's dividend safety in the context of the company's current earnings. When Broadcom announced its fourth quarter financial results on December 6th, the company reported that it generated earnings per share of $20.82 for the fiscal year 2018. For context, Broadcom paid $10.60 of common share dividends during the same time period for a dividend payout ratio of 51%. Using earnings, Broadcom's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Broadcom's current dividend payment to its free cash flow. During fiscal 2018, Broadcom generated $8.88 billion of cash from operating activities and spent $635 million on capital expenditures for free cash flow of $8.25 billion. The company distributed $3 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 36%. Using free cash flow, our conclusion is the same as when we used earnings to Broadcom's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Broadcom's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Broadcom's performance during this time period is shown here. Broadcom's earnings per share declined into losses during the last recession. Fortunately, the company was not paying out a dividend during this period, so it didn't have to worry about covering it. However, if this happened today, it would have a difficult time sustaining its dividend. Thus, while the payout ratio is fairly low relative to current earnings, if the company generates losses in a future recession, its dividend could very well be at risk. The last angle that we will use to assess Broadcom's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, Broadcom generated $628 million of interest expense and had $17.5 billion of debt outstanding for a weighted average interest rate of 3.6%. The following image shows how changes to Broadcom's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Broadcom's weighted average interest rate would need to rise above the 33% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Broadcom's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Broadcom's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.